Global risk surge. Market volatility signals deeper economic instability. Recent stock market fluctuations aren't just temporary jitters, they reflect mounting systemic risks across the global economy. The situation isn't about one single threat, but a convergence of factors, from speculative bubbles in tech and crypto to unsustainable debt levels and unpredictable policy shifts. The AI boom and crypto volatility, the rush of capital into artificial intelligence, AI, is creating conditions similar to past market manias. Billions are being poured into a sector that, while promising, carries significant uncertainty. Simultaneously, the integration of cryptocurrencies into traditional banking is accelerating despite their extreme price swings. This combination is especially concerning because crypto's volatility could spill over into the broader financial system, given its increasing connections to mainstream institutions. The recent bankruptcies of shadow banks underscore the risks of unregulated lending practices. Debt and policy uncertainty beyond speculative bubbles. Governments, particularly the US, are carrying historically high debt loads. This makes economies more vulnerable to shocks. The unpredictability of US economic policy adds another layer of risk. Former President Trump's policy swings, compounded by the potential for legal challenges to trade tariffs, like those imposed during his administration, introduce additional uncertainty into the global landscape. The paradox of market optimism: despite these headwinds, stock markets remain elevated. The S&P 500 is still up roughly 14% this year. However, Harvard economist Kenneth Rogoff warns that this optimism is misplaced. He argues that high stock valuations aren't driven by genuine economic growth, but by anticipation of corporate labor cuts. Firms expect AI to boost profits by reducing workforces, which is why their shares are priced accordingly. A big part of the high stock prices is not a reflection of high future growth. The firms all think they're going to shed a lot of labor, and that's why the profits will be high. Kenneth Rogoff, this means that market gains may be built on an expectation of widespread job displacement, a grim underlying reality masked by superficial optimism. The situation suggests that volatility is likely to persist, and the current market rally could prove unsustainable as these underlying risks become more apparent. Ultimately, the convergence of these factors creates a highly unstable environment where systemic shocks are increasingly probable. The low volatility observed in earlier periods was an anomaly, and the recent market shifts suggest a return to more realistic risk assessment.